Hello everyone, welcome back. Here is Ali Talabi and this is module 16. In this module, we are going to talk about economic and industry analysis. So we'll have two lessons. In the first lesson, which is today, we'll talk about top-down and bottom-up analysis. We'll talk about macroeconomic activity, business cycle and industries, economy indicators and investment, and finally, international investment and exchange rate. So let's start our session. So when it comes to investment, we have two major approaches and when it comes to fundamental analysis. Either you can go with the top-down analysis or bottom-up. Maybe you say, Ali, what's the difference? The bottom-up analysis starts from the company. So it looks at the company-specific fundamentals such as financials, supply and demand, and different type of goods and services which are offered by company. And based on that analysis, actually you decide regarding your investment. And then you will consider some other factors which are related to industry or the whole economy. However, in the top-down analysis, you start from the big picture. So you look at the economy first, and you see that what are the major economic factors, and then based on that, you decide whether you want to invest or no. And if everything is okay, then you go to the next level, which is the industry analysis, and you look at different sectors and you choose the appropriate industries. And finally, within each industry, you choose appropriate firms and you start your investment. The second approach, which is top-down, is the kind of more preferred, more common way of looking at the investment process. So let's look at the top-down analysis, which, as I mentioned, is a kind of more common way of investment, more common investment process. So you can look at that top-down analysis as like a funnel, kind of upside-down funnel. And so you start from economy, and then you go industry, and finally go to a specific firm or company. So you start with all possible or feasible investment, which goes at the top of the funnel, and then based on the economic, industry, and the company analysis you conduct, you as an investor decide what are the best potential type of investment you can follow. So as you are following down, as you see in the funnel, your investment options are going down. In other words, you are narrowing down your investment options and you choose the right company. So the first level is economy. So you have to look at macroeconomic activity. So there are several factors which you have to consider. So for sure, one of the major one, which is used to measure the economic health, is called GDP or gross domestic product, and it shows the total services and products which are produced within a year in a specific economy or country. However, you have to be careful because the GDP most of times you see are based on nominal numbers, which is called nominal GDP. And instead of the nominal GDP, I encourage you to look at the real GDP. What's the difference between the real GDP and nominal GDP? Real GDP takes out the impact of inflation. So we know different economies, different countries, they have different inflation rate. Higher inflation will lead to the higher nominal GDP. So it's better to look at the real GDP instead of nominal GDP. If you're looking for a better approach, I would say even you can go one step further and look at the real GDP growth. So which is showing the growth of real GDP over time. That's a better indicator of the economy and how big is the economy, how much the economy is growing. So look at the real GDP. And based on several research and studies, there is a positive relationship between the GDP growth rate and the stock market value. So if the GDP is growing and the real GDP is growing, in this case, you should expect the actual real value of the stock market is also growing. So in other words, you can use the real GDP growth as an indicator of the performance of the stock market as well. Now, when you look at the economy of the country, you should notice that there are some cycles within each economy, which we call that business cycle. So in other words, when you look at the GDP, you see that there are some times that the GDP is growing faster, sometimes GDP is going down. So you see those fluctuation, ups and downs. So these ups and downs are called business cycle. So there are four major stages in each business cycle. So you have the peak of the economy when the actually GDP is it's at the highest rate, highest level. And then you have it follows by it is following by a contraction. So the economy is becoming smaller, and then you have the minimum level of the economy growth, which you see it's called trough actually, and then it follows by expansion or recovery, and then you go back to peak. So peak, contraction, trough, and expansion. These are four major stages you see in business cycle. So when you want just to invest in a specific economy, you have to consider the fact that you might be in different stage of the business cycle. So that's a very important factor. So for example, you want just to go with a stage in which you expect expansion. So maybe if you are in the beginning of expansion or the end of contraction, so you are bottom of the cycle, that's the best time to invest, to go to the market. If you are getting closer to the peak of economy, that's the best time just to actually exit from the market. Now, again, why this is kind of important to us to understand the business cycle? Because most of industries are also moving with business cycles. Now, the sensitivities of these industries, for sure, it kind of varies. So some industries are more sensitive to the changes in the economy and the business cycle. Some of them are less sensitive. So if you're talking about cyclical sectors are those industries which are more sensitive to the business cycles. What are the examples? Industrial sectors, material sector, and if you expect the economy is going to perform well, usually these sectors, cyclical, are performing much better under these situations. So you will get above average kind of return if you invest in those kind of industries. So because they're much more sensitive to the business cycle. However, if you're expecting the market, the industry is cyclical and the economy is going through contraction, it's not a good kind of idea to go with cyclical sectors and invest on those sectors. So rather, you might go with defensive sectors. What are these defensive sectors? They are much less sensitive to the business cycles. The examples are healthcare and consumer staples, and it's very logical. So even the economy is shrinking, people still they need to have the healthcare. So maybe their spending on healthcare is not changing that much. So you might consider investing in defensive sectors if you expect the economy is entering into contraction stage. So again, if you expect a strong growth for the economy, if the economy is growing, go with cyclical sector. If you expect the economy is growing slower, it's entering into contraction, go with defensive sector. So for sure, you heard about the economic indicators. Usually, we use economic indicators to monitor the health of the economy. So these are kind of important. Why? Because they help us just to make a right decision when it comes to investment. So a very common question here is whether it's possible to predict the stock market. So we can use these economic indicators to forecast to some degree the future of economic conditions, and based on that, for sure, we can decide regarding your investment. There are three major economic indicators. Some of them are leading economic indicators, and you have to focus more on these ones because they help you just to see the next move of the market, so you can use them to predict the market and make a right decision. We also have two other group of indicators which are called lagging indicators and coincident or simultaneous indicators. So the leading economic indicators are average weekly hours, manufacturers' new orders, purchasing managers index. Maybe say, Ali, what is the PMI? PMI is actually the index of the prevailing direction of economic trends in the manufacturing and service sector. So if this index is improving, is going up, you should expect the economy is going to grow, and in result, you should expect a better situation. Remember, again, investors, they try just to use this economic information to help decide when and where to invest. They want just to identify the specific sectors and the timing of their the investment. Now, it's kind of interesting to see that stock market indices are mentioned as one of the leading economic indicators. So if that's one leading economic indicator, but we are going to use that also to predict the stock market movement. So now it's the issue of chicken and egg. So actually, the stock market index is one of the most accurate indicator of the leading economic indicator. Now, the accuracy is consistent with the fact that the stock market does not reflect the current condition. Remember, the stock market is about the expectation, is the present value of all future cash flow, all the future upcoming news. So you're talking about the future news to some degree. The stock market is usually looking at the future, and I'm talking about the maybe around 6 months future. So it's not for the current situation. So if we consider the fact that the stock market is looking at the 6 months period, now we can understand why it is considered as a leading economic indicator, because you can expect that whatever you see in the market, in the stock market, soon you will see in economy. I hope it helps to understand how closely these economic indicators and the stock markets are related. One of the major factors when it comes to international investment you need to consider is exchange rate. And that's one of the key economic factor, the exchange rate. Now, I have an example here. I'm going to show you how actually it helps you just to earn more, or in some cases to lose money when it comes to international investment. So if you are, for example, you have money in Canadian dollar and you want just to invest in the US market, US stock market, so you have to convert your Canadian dollar to the US dollar. So you are exposed to the risk which we call currency risk, how it can actually hurt your return. Now, let's look at this example. Let's assume you have 1,000 Canadian dollar and you intend to invest in the US market. And the current exchange rate is 1.25. So for each US dollar, you have to pay $1.25 in Canadian dollar. So when you're converting 1,000 Canadian dollar to the US dollar, you just get 800 US dollar. In other words, you need to divide 1,000 by 1.25, which gives you 800 US dollar. Let's assume you are going to invest in the stocks of Apple, and the current stock price is 100 US dollar. So you can buy 8 shares of Apple with your 800 US dollar. Now, 1 year later, you're lucky the Apple stock price goes up from $100 originally to 110. So what's happening in this case? You are making 10% return on your US investment. Now your 800 US dollar, it becomes 880 US dollar. So you're making 80 bucks or 10% of your investment. However, you don't need the US dollar. You want just to spend your money in Canadian dollar. So you are converting back the US dollar to your own local currency, which is Canadian dollar. However, the exchange rate is not the same. It's changed now to 1.1. So what's happening here? For each US dollar, you're just getting 1.1 Canadian dollar, which used to be 1.25, so much less. So you will get 968 Canadian dollars. So what happened here? You made 10% on your US stock investment. However, you ended up losing 3.2% on your total investment, which was in Canadian dollar. So the problem here is that you lost on the exchange rate. It was 1.25 and now it's 1.1. So the point here is the exchange rate is a very key factor, very important factor when it comes to international investment. So you have to consider because it can ruin your return. So you have to be careful with that. So there are some funds and there are some exchange traded funds. There are some funds which are Canadian dollar hedged or they're hedged to other currencies. So if, for example, your money is Canadian dollar and you want just to go with the US market, you can go and choose those ETFs or funds which help you just to hedge your Canadian dollar against US dollar fluctuation. You don't need to be worried. You don't need to do anything. Just you buy the shares of those ETFs and you are automatically hedged to the currency risk fluctuation. That's it for today. Thank you very much. Next lesson, we'll talk more about economy and industry. Till that time, have a wonderful day. Talk to you soon. And here is Ali Talabi.